Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Bioage Labs Inc. Annual Report. Bioage Labs Inc. offers a range of businesses and services in the biopharmaceutical industry. The company's primary focus is on developing therapeutic product candidates for metabolic diseases using its proprietary technology platform and human datasets. One of the key areas of expertise for Bioage Labs is the development of small molecule NLRP3 inhibitors, such as BG-102, which has shown promise in treating atherosclerotic cardiovascular disease, diabetic macular edema, and geographic atrophy. Additionally, the company is working on APJ agonists for obesity, with programs targeting both oral and parenteral administration. Bioage Labs also collaborates with other companies to advance its research and development efforts. For example, it has a collaboration agreement with Novartis Pharma AG to identify and validate novel therapeutic drug targets related to aging and disease mediation. This partnership allows Bioage Labs to leverage the expertise of a leading pharmaceutical company while advancing its own research goals. Overall, Bioage Labs' businesses and services include product development, research and development collaborations, and technology platform utilization for identifying and validating therapeutic drug targets. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a review of the financial report's extracted summaries. On the growth side, several key factors contribute to an increase in revenue. The successful completion of clinical trials beyond Phase 1 billion and obtaining regulatory approvals are significant milestones that pave the way for increased revenue. Collaboration with major pharmaceutical companies like Novartis also plays a crucial role, as seen through the Novartis agreement. This agreement brings in upfront payments, research funding, milestone payments, and royalties on net sales of licensed products. On the other hand, several factors contribute to a decline in revenue. Delayed or terminated product development or commercialization efforts can significantly impact revenue projections. Granting rights to develop and market product candidates to third parties also leads to a decrease in revenue as the company loses control over these projects. Decrease in deferred revenue related to the Novartis agreement is another factor that contributes to revenue decline. Other drivers of change include adjustments related to research effort, transaction price changes, and cumulative catch-up adjustments on contracts. These factors can have a significant impact on revenue projections, but are less direct than the primary drivers mentioned earlier. Overall, understanding these drivers is crucial for making informed decisions about investments in companies with varying revenue growth or decline prospects. The net income of the company has been a subject of concern for several years. Initially, the company reported negative net income due to substantial losses incurred in connection with planned and ongoing clinical trials. The situation worsened over time, with the net income decreasing by $9.5 million from 2024 to 2025. Unfortunately, the company's financial performance continued to decline, resulting in a net loss of $80,605 for the year ended December 31, 2025. The profit margins of the company have also been affected significantly. Due to the lack of revenue generated since inception, the company has incurred significant losses and is expected to continue doing so in the foreseeable future. As a result, profit margins are anticipated to remain low or non-existent in the near future. The company's dependence on third-party manufacturers and suppliers, failure to comply with environmental laws, and increasingly stringent regulations have further exacerbated this issue. The financial performance of the company indicates a concerning trend. The extracted summaries reveal that the company is struggling to generate positive operating cash flow. For both 2025 and 2024, the company has reported negative operating cash flows, with losses totaling $81,627,000 in 2025 and $51,522,000 in 2024. This lack of positive operating cash flow is a significant concern for the company's financial health. The fact that it relies on external funding through equity offerings, debt financings, or other capital sources to sustain its operations suggests that it is not generating sufficient revenue to cover its expenses. This trend raises questions about the company's ability to maintain its current trajectory and achieve long-term sustainability. The company's debt level and interest expenses have undergone significant changes in recent years. Regarding the debt level, as of December 31, 2025, there was $2 million outstanding principal under the term loan. However, no significant changes were mentioned in subsequent pages. This suggests that the company has maintained a relatively stable debt level over time. In terms of interest expenses, there has been a notable decrease. The interest expense decreased by $1.67 million, 71% decrease, from 2024 to 2025. Additionally, the interest expense also decreased by $1.7 million during the same period. These decreases indicate that the company has managed to reduce its interest expenses significantly over time. The management is expressing concern over the company's financial performance, citing a significant increase in expenses compared to revenue, resulting in a net loss of $80.6 million in 2025. Despite this, the company has made progress in advancing its product candidates, with substantial research and development expenses of $24.5 million. The management is also highlighting the company's focus on extending healthy human life by targeting molecular causes of aging, which is reflected in the single reportable segment. However, the financial performance indicates that the company needs to improve its revenue generation to offset increasing expenses. In a positive note, the company has completed an underwritten public offering of its common stock, issuing 5.9 million shares at a public offering price of $19.50 per share for net proceeds of $107.6 million. This move is expected to provide the company with additional capital to fund its operations and advance its product candidates. Overall, the management's outlook suggests that the company is focused on advancing its product pipeline while addressing its financial challenges. The company needs to improve its revenue generation and manage its expenses effectively to achieve profitability in the future. There are no acquisitions or divestitures mentioned in the extracted summaries. The only notable mention is the termination of Azlaprag, a development project that was discontinued. This does not fall under the categories of acquisitions or divestitures, but rather a cancellation of a project. As a result, both acquisitions and divestitures can be classified as none. Based on the information provided, it appears that the company has a history of not paying dividends to its shareholders. This suggests that the company may be prioritizing reinvestment in the business over distributing profits to investors. The lack of any mention of share buybacks is also notable, implying that the company has not been actively purchasing back its own shares on the market. Concerns about inventory buildup and supply chain disruption are valid given the current situation. One of the primary concerns is the recurring shortages of non-human primates for preclinical studies, which can hinder research progress. Additionally, potential difficulties in managing growth and expansion of operations could lead to increased costs and divert management resources away from core activities. This could further exacerbate supply chain issues if not properly managed. The possibility of product supply disruption due to changes in U.S. policies or actions by Chinese governments is another concern. Such disruptions can result in increased costs, reduced efficiency, and ultimately impact the overall business operations. Lastly, disruptions in logistics routes and transportation capabilities pose a significant threat to the supply chain. This could lead to delays, increased costs, and potential losses if not addressed promptly. That concludes the financial summary for Bioage Labs Inc. Feel free to comment below, and I will be happy to answer them when possible.